I don't usually comment on macroeconomic or political issues, but yesterday and today were interesting. Yesterday, the Fed lowered interest rates by 25 basis points, and today, the interest rate on the 10-year and the 30-year actually rose significantly, not following the Fed's move lower on interest rates. That affects things like mortgages, auto loans, credit card interest rates, and so on. A lot of people, including the Trump administration, would be very disappointed by that because that means that even if they were to bully the Fed further to lower interest rates further, it would actually have the reverse effect of increasing interest rates because the Fed only sets the overnight rate that affects bank lending between banks. They don't actually set the interest rate that affects things like mortgages, credit cards, and auto loans because that it depends on the 10-year. And the 10-year has its own market, and that market is independent. It prices the bonds based on inflation expectations, fiscal credit rating, all those kind of things, where the economy is headed. The market basically sees inflation continue to be higher, which makes sense because a statistic came out recently that more than 50% of spending, consumer spending, is driven by the top 10% of income earners. That means that the wealth effect, top 10% means they have a lot of assets. That means the wealth effect from this AI bubble sensation in the market is actually driving spending. And if the spending is driven by a wealth effect, that means that the market has to go through an extended slump or correction in order for inflation to come down. That doesn't seem to be happening anytime soon, and the political appetite for that is non-existent. So it seems like inflation will continue to be an issue, and the Fed's ability to lower interest rates is like pushing on a string. They can lower the overnight rate all they want, but the market is not going to price the 10-year yield lower because it expects inflation to continue to be an issue.